Let's talk estimated taxes and withholdings from pensions and retirement account distributions on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today we're talking estimated taxes and withholdings from pensions and retirement accounts like TSP, 401k, IRAs, distributions, right? Withholding from distributions from those types of accounts. So to start off, kind of a review, most people are probably super familiar with estimated taxes, right? If you didn't withhold enough taxes throughout the year from either your wages or your Social Security or pensions, you may have to make these estimated tax payments, right? And this is most common with people who have maybe side hustles or self-employed, or maybe you have a rental property that's generating income, and there's no withholdings, right? When you get your rental income every month, you're not withholding any for taxes, right? And that's where the estimated taxes come in. So who needs to pay estimated taxes? Anybody who has a tax liability. Typically it's over, you have to cross the $1,000 or more threshold of taxes owed. And there are a couple safe harbor provisions that we'll talk about where it's kind of a get out of jail free card. As long as you cover these safe harbor rules, then you don't have to worry about underpayment penalties. And you still could possibly want to pay these estimated taxes quarterly, but you don't have to worry about the penalties as long as you meet these safe harbor rules. Okay, so we all know estimated taxes quarterly, right? Pretty obvious. So it's usually due the 15th day of the next month after the quarter. So an example would be first quarter would be January 1st to March 31st. And then that quarterly payment is due April 15th, right? Next month, 15th day. For Hawaii, it's usually the 20th of the month, right? The 20th day. And anytime, whether it's federal or state, that the deadline falls on a weekend or holiday, it's typically pushed back to the next business day. Okay, so it's good to keep track of and think throughout the year, will I owe estimated taxes? There's a couple different ways you can go about doing that. There's this IRS withholding estimator where you can go on, it asks you a bunch of questions and prompts, and you can figure out how much you should, pay for quarterly estimated taxes throughout the year. And typically if you use tax software or you work with a tax professional, a CPA, an enrolled agent, and you get your taxes at the end of the year, they usually have the vouchers and their recommendations for what you should pay in estimated taxes throughout the year, if you need to. Some people don't need to pay any estimated taxes. You have enough withholdings, and it really doesn't pertain to you. Okay, so the safe harbor rules that I talked about, right? First, I said there's that $1,000 in tax threshold, right? You have to owe $1,000 after your credits and your deductions and all of that. The other part is there's this safe harbor rule where if you pay 90% of your current year's tax liability, okay, I'll repeat that, 90% of your current year's tax liability, or 100% of the prior year's tax liability, then you satisfy the safe harbor. You don't have to worry about underpayment penalties. Okay, it may be hard to predict what 90% of this current tax year might look like, especially if your income fluctuates quite a bit. And if that's the case, you just focus on paying 100% of the prior year's tax liability. Now, one caveat to this 100% of the prior year's tax: if your adjusted gross income, AGI, is over $150,000, then instead of 100%, you have to pay 110% of the prior year's tax liability to meet the safe harbor rules, and not have to worry about the underpayment penalties, right? And so it's also important to keep in mind that these 100% of the prior year's tax or 90% of the current year's tax, this is a combination of both withholdings and estimated tax payments, right? This isn't just you need to withhold 100% of prior year's taxes. You need to have that in withholdings, either from wages or pensions. You just need 100% of prior year's tax, or 110% if your AGI is over 150,000, between your withholdings and quarterly estimated tax payments, right? And if you meet that threshold, then you're good to go. And typically that translates over to the state side too. I'm not familiar with every state's safe harbor rules, but typically if you meet the federal safe harbor rules, more often than not, you should be in the clear on the state side. So let's talk about, there's a couple ways to pay your estimated taxes, right? You can set up an IRS online account. There's IRS direct pay where you don't need to register, and you can kind of do this like one-time sort of payment. And then you can set up automatic payments through the EFTPS, Electronic Federal Tax Payment System, where you can schedule payments and you can track them, and you can set it up so that it pays, weekly, monthly, quarterly. Just because they're calculated and accrued quarterly doesn't mean you can't make estimated tax payments weekly or monthly or whatever it might be, right? In Hawaii, you got to go to Hawaii Tax Online. It's hitax.hawaii.gov. And there you can pay through ACH right through your bank or your credit card, debit card. I think there's a small fee if you're going to pay your estimated tax with your credit card. I like the online route. You can do this stuff through mail-in options, but through the online, you get that instant confirmation. You know that it's good to go. I think the mail is pretty surefire, but you just never know. Once that thing leaves your mailbox or you drop it off, did it get there? And it's kind of a mystery until you see it post, right? Okay, one last thing about the underpayment penalties before we get into retirement account distributions and pension withholdings. The underpayment penalties, you never want to leave the IRS a tip, right? That's the joke. But it's not the end of the world, especially if you're under by a little bit. It's not, the penalty typically isn't the end of the world, so it's not something that you need to lose sleep over. Obviously, we want to try to avoid it. And on the same kind of vein there, I know a lot of people say, they operate with the mentality of, I want to pay as little tax as I can throughout the year because I could be investing that money, right? And I think that's totally valid, and I agree with that. For most people, you probably have that money sitting in a checking account earning next to no interest anyway. Maybe, is it really that large of a sum? I think in theory it sounds great. I operate personally by just, I'd rather come in at the end of the year having paid a little bit too much rather than a little under. And that's just for no other reason than that's how my psychology works, right? But to each their own. I get it. You definitely don't want to give way too much throughout the year where you're going to, you overpaid by thousands and thousands of dollars. But I don't think you should worry about hitting it quite spot on the mark every time. Okay, so now let's get into the fun stuff. Tax withholdings from retirement account distributions. We'll start with retirement account distributions, and then we'll talk about withholdings from Social Security and from pensions. The key point that I want to hammer home here is the IRS treats taxes withheld from retirement account distributions. Okay, so we're talking TSPs, 401ks, IRAs, 457s, 403bs. Those withholdings are deemed as pro rata, paid evenly across all quarters, regardless of when distributions actually occur, right? So if you take a distribution in the fourth quarter and you withhold whatever, $10,000 in taxes, right? It's a big distribution. The withholding is spread out throughout the year, so it's kind of like you're withholding $2,500 through in the first quarter, $2,500 in the second quarter, $2,500 in the third, $2,500 in the fourth. Now, why that matters if you don't meet those safe harbors is, like I said, it's a combination of estimated taxes and withholdings that allows you to meet your tax liability. So there can be some planning opportunities in that, let's say, you're under for the year. I didn't pay enough taxes, and I might be hit with a penalty due to underpayment maybe in the first or second quarter. What you can do is take a distribution from these retirement accounts, your TSP, 401k, IRA, 457, 403b, and take out a large amount as withholdings. and that gets spread out throughout the year. And that way, maybe that'll help you, top you up so you don't have any underpayment penalties for the year. Maybe you accrued a lot of income later on in the year, and you're like, well, I didn't anticipate that, and you're underpaid. You can use these retirement account distributions to make up for it in past quarters, right? So much so that you can actually, like, let's say you did a $10,000 distribution from an IRA, you can deem, or your TSP, you can deem all of that as withholdings, right? Up to 100%. So you're actually getting none of it, and it's just like you're making a $10,000 tax payment in withholding spread out throughout the year, right? So, it might never apply to most people, but it can be a good kind of planning opportunity if you need to make up for, tax payments in earlier quarters. So just to get into there are some mandatory sort of withholdings or some defaults that you'll see. And this is pretty much true across the board as far as I know. But it is also good to understand custodians are different, especially when it comes to the state side of things with the withholdings. It does vary custodian to custodian. And I'll give you an example of that is the TSP doesn't allow for any state withholdings, right? So maybe, your IRA allows for state withholdings, or, some other 401k, or maybe it's your 457, but the TSP does not, right? That's an example of how custodian to custodian, you got to check to see, do they allow for state withholdings? But some of the federal stuff is kind of default, and it kind of is what it is across the board. For instance, if you have a traditional IRA, the default federal tax withholding is 10% on distributions, okay, from your IRA. If it's over $200, right? I think if you take out less than $200, the default doesn't apply, right? But most times if you're taking a distribution, it's going to be over $200. It starts at 10%, right? Now you can change this, but that's the default. So you can have no withholdings from your traditional IRA, a custom percentage, whatever you think, or like I said, up to 100%. But the default is going to be 10% from your traditional IRAs, right? That's your pre-tax money. So when you look at your TSPs, your 401ks, 403bs, and the similar plans like that, typically the default is the 20% federal income tax withholding, right, from the distributions. And you also see this with if you want to do a rollover. Let's say you want to do a $10,000 rollover. They're going to withhold $2,000, which is 20%, and they're going to cut you if you don't do direct transfer to transfer. Custodian to custodian, a direct transfer, and you get the check, right? That's the old school way of doing it. You get the check. It's actually going to be for 80% of your distribution because they're withholding 20% as taxes. Now, when you do that rollover within the 60 days, you're responsible for depositing the full amount, the full 100% of your distribution to complete that rollover. You don't just deposit the 80%, right? Because then you have 20% that was withheld for federal income taxes. It didn't follow through the process of the withholding. That's going to be treated as a distribution. Okay, so like I said, you can avoid that all by just doing, and I think it's always best, again, going back to paying estimated taxes through the mail. Same thing with the doing these rollovers via the check. I mean, if it's possible, why not do the direct ACH, custodian to custodian direct transfer? You don't got to worry about the mail thing or getting the check and the withholdings, right? And there are some other kind of exceptions. I'm not going to go into all of them, but from your 401ks, TSPs, 403bs, 457s, like I said, direct rollovers. If you do substantially equal periodic payments, right? This is like the 72T, right? Then the 20% default federal tax withholdings doesn't apply, and then other things like hardships, disability, and so on. Required minimum distributions, their actually default rate typically is 10%, right? So if it's if this distribution is a required minimum distribution, the default is the 10% instead of the 20% that I mentioned earlier. And I'm not expecting anybody to listen to this, remember all these percentages and this and that, but it's just to be aware of when you go in to make a distribution, whether that's from your IRA or your TSP or 401k, contact a custodian, think about taxes, think about these estimated taxes, think about the safe harbor, when you do these distributions and kind of plan out how much should I withhold, right? So I don't expect everybody to remember all these percentages and defaults, this and that, but just kind of food for thought to think about. Now, when it comes to the state withholdings, again, it varies a lot by state and custodian. Typically, there's some states that are mandatory withholdings from retirement account distributions. Some have none. Like it's prohibited. You don't withhold at all. And some are voluntary, right? And again, the TSP does not withhold for state or local income taxes, regardless of the state, right? So that you can see that's a custodian where even if you wanted to withhold state taxes or your state is one of these states that requires it, you can't do it through the TSP. That's a custodian limitation, and you just got to make it up, through estimated taxes through your state or whatever it might be, right? You might want to increase withholdings in Social Security or your pension or whatever it is. Hawaii is one of those states that does not allow state tax withholdings on retirement income distributions. Okay, so it doesn't allow it. So that doesn't mean it's not the IRA distribution or the whatever it is isn't subject to income taxes in Hawaii, state income taxes. It is, it just doesn't allow for, it's one of those prohibited, it doesn't allow for state tax withholdings. So you just gotta account for that elsewhere, whether you're gonna make state estimated tax payments or you're going to increase withholdings elsewhere, right? Okay, so now let's move over. That's kind of retirement account distributions. Again, food for thought. Don't lock into any of that stuff specifically for numbers, this and that. It's just I want to bring it up to keep it in mind for when it comes time for you to make distributions from your retirement accounts. Okay, so let's talk about Social Security and pensions. You can adjust your Social Security withholdings, right? Hawaii does not tax Social Security benefits, so there's no state tax withholdings, right? It wouldn't be applicable. But you are going to make federal tax withholdings, at least you could. It's entirely voluntary. You don't have to make withholdings from your Social Security, and you can stop it or change it at any time. Typically, when you're going to set up your Social Security for your first time claiming, you're gonna pick a percentage. The available withholding rates, so you can't just pick any amount or any rate, right? It's kind of I think there's 4 specific percentages you can choose from for federal withholdings from Social Security, and those are 7%, 10%, 12%, or 22%. Hopefully that info is correct. I don't know if that maybe that changes. In different years, but that's the info I got. Even if it does, there's set percentages, right? So I got 7%, 10%, 12%, and 22%. So you choose a percentage for withholdings, right? But like I said, there may come a time when you're like, well, I notice I've been starting to pay more and more in estimated taxes to cover my tax liability and avoid underpayment penalties. And you might want to go back in through your SSA.gov account online, and you might want to change it. Maybe you want to increase it from 12%. I want to change it to 22% federal withholding, so I don't have to worry about these estimated tax payments. Same is true from pensions. It's pretty much the same thing. There's a form W-4P. So everybody's familiar with W-4, right? If you start a position, you start a job, that's your kind of tax withholding form. The IRS form W-4P is kind of the same thing. It's just for pensions, right? And you're gonna use this form with your plan administrator. They may have a different process or a different processing time or how they go about it. I know for FERS, you can go online. The Hawaii Retirement System, the ERS, you actually have to give them a original signature, right? And so you can't. There's no online option. You got to either mail it or I guess you could bring it in and drop it off. But it's that form W-4P. You can set up your tax withholdings from your pension when you originate, right? Your pension when you turn it on, and again, you can change it at any time, right? To account for whatever changes you have going on in your life. The other thing to consider, just like I said about Social Security, right? Hawaii as a state does not tax Social Security. Hawaii as a state taxes now, does not tax most public and private pensions. right? I don't know. There may be some caveat to that, but for the most part, right, like for our federal workers, our state workers here, city and county, all that kind of stuff, Hawaii is not going to tax at the state level your pensions. So really, then it comes down to whether you need the federal withholdings. And so I know that's a lot to go over, a lot of numbers there, but it's just some food for thought about the safe harbor rules, right, that get you out of being subject to underpayment. That was 90% of this current year's tax liability or 100% of last year's tax liability. If your adjusted gross income is over $150,000, that jumps up to 110% of last year's tax liability. Estimated taxes, sometimes, I've come across people recently who are like, I just don't want to deal with it, and they want to increase withholdings from Social Security and their pensions so that they don't have to be bothered, right? Because it is one thing that, it can slip your mind, it can fall through the cracks. But the underpayment penalty typically isn't the end of the world unless it's a massive underpayment. But it's just something, monitor your income regularly, kind of plan ahead. If you work with a tax professional, CPA, enrolled agent, usually they got you dialed in. They give you the vouchers, and or even if you use tax software to kind of meet the safe harbors, and or if you have something coming up down the pipe where your income's gonna go through the roof this year for whatever it is, they can help you plan for that. All right, I think that wraps it up. If there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Katita, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.